Imagine if you could reduce your taxes by up to 37% simply by changing this one aspect of how you invest inside your corporation. Today, I'm going to be walking you through exactly what that is and how it could save you hundreds of thousands, if not millions of dollars over a 30-year time period. So last month I touched on interest rates and how they've been rising so far this year. And one of the positive aspects of this is you can now earn a much higher rate of return on cash balances, either for your corporate assets or your personal assets. At a minimum, this rate of return should be 2.5%. And if the Bank of Canada increases rates further in September, that rate should be about 3% on cash balances. Now, if you keep your money at the bank or you're dealing with a bank advisor, there's a good chance you actually do not have access to some of these products that are available to you. And I'm going to link a Globe and Mail article below where certain banks have actually banned their advisors from offering these high interest savings products to clients because they would prefer the advisors use their own the bank's proprietary in-house products where they would make more money. Obviously, that's not in the best interest of you, the client, and we do not have that restriction at EA Financial. So if you're looking to earn a higher rate of return on your cash balances, please feel free to reach out to me. I would love to be able to provide that for you. I'm going to put a link down below where you can reach out to me for more information. Now, onto the topic of today's video. What is that one aspect, that one thing that you can change of how you're investing inside your corporation to save you hundreds of thousands, if not millions of dollars? Well, it all comes down to the type of income you're earning passively inside your corporation. To understand this in more detail, let's first take a look at the different types of income you can earn inside your corporation. To start off, there's interest income, and earning interest income passively inside your corporation, you're going to be taxed at 50.17%. If you earn dividend income, and this is Canadian dividends that are subject to the general corporate tax rate, those are taxed at 38.33%. And there's capital gains, which are taxed at 25.08%. Now, obviously, capital gains is the most tax efficient. So if we take a very basic example and we assume $250,000 of retained earnings inside your corporation, and we earn a 5% rate of return for 30 years, if we're focusing on interest income, the final growth of the account will grow to over $520,000. Focusing on dividend income, we'll get it up to just under $630,000. And if we were focusing on capital gains, that account size would grow to $770,000. So obviously, capital gains, we have over $250,000 in extra growth. And when we look at the actual taxes paid over that time period, for capital gains, we paid $174,000 in tax. Dividends, if we were focusing on dividends, we would have paid a little bit more. And of course, the most is interest income, where we would have paid over $278,000 in tax. Now, in this scenario, you have a reduction of 37% by focusing on capital gains versus interest income earned inside your corporation. Now, you can see this is a very basic example, but if you're adding to your account or your rate of return is higher over a 30-year period, this could easily be a tax savings in the millions of dollars simply by focusing on capital gains as the type of income you're earning. Now, you may be asking, John, I'm a low-risk investor. I don't want to take a lot of risk with my corporate or personal assets. Is there a way I can still earn capital gains even though I'm a low-risk investor? And the answer is yes. And the types of investments you could focus on would be corporate class investment structures. Now, what is a corporate class investment structure? I'm going to try and paint that picture for you. Imagine there's 5 funds, and of these 5 funds, they're all wrapped up in one corporate structure. I'm going to walk you through an example here. There's one bond fund and the rest are high growth funds, okay? The interest, dividend, capital gains, and expenses of all 5 of these funds are all shared under the corporate umbrella. Now, for a very basic example, let's assume each of these 5 funds had expenses of $1,000. The bond fund had interest income of $5,000, and each of the 4 growth funds had capital gains of $6,250. All in all, there was $5,000 of expenses, $5,000 of interest income, and $25,000 of capital gains. Now, the interest income can be completely offset by the expenses that the corporate structure had, and what's left is $25,000 of capital gains split out amongst 5 funds. So how that looks is that each fund gets a $5,000 capital gain distribution, and so if you're the owner of this bond fund that's under the corporate cost structure, you would actually receive a $5,000 capital gain distribution versus an interest income distribution. That's obviously much more favorable, as we discussed previously. So while that was a basic example of how corporate class structures work, I hope you found this video informative and can now appreciate how beneficial it is to focus on capital gains type distributions inside your corporation versus dividends or interest income, and how it could save you hundreds of thousands, if not millions of dollars over a longer time period. If you have any more questions about corporate class investment structures or how to reduce your tax inside your corporation or in your non-registered accounts personally, please reach out to me. I'd love to help you. The link to book a call with me is down below. Talk to you soon.